Well, good morning, everybody. My name is James Harries. I'm the manager of the Securities Trust of Scotland. You've heard a lot about Troy already, but let me just take you through a little bit more about, I'll try and synthesize what's going on in the markets, how we're approaching it in terms of dividends and investing. The Securities Trust of Scotland, Francis mentioned, we won in November 2020. We were delighted to be appointed by the board to manage what we want to be the quality, low volatility, global income trust in the sector. We don't actually think there is another one quite like it, and we think it's a really attractive thing for investors to invest in today, given the backdrop. Now, just to be contrarian, I'm going to change the order of the slides. Now, this is to try and put some numbers and some history around what Sebastian was saying, because I think you can always get the impression that Sebastian's pretty cautious right now. And I think that's quite sensible. This is various variables relating to the US economy in 1981 and today. The other remarkable thing about this chart, I think, is that Ronald Reagan looks quite fresh-faced, which probably doesn't say a great deal for Joe Biden. But if you look at it in 1981, it was actually a fabulous time to be investing. Didn't feel like it. It's been through the 70s and the oil shock and winter of discontent and all of that. But you had real value. So you had 14% 10-year Treasury yields relative to, that's at the end of the month, they're about 3% today. You had 14% interest rates, which obviously could come down, because 1981 was the time when equity and bond markets began a structural big upward move, arguably the last of which we've just experienced. Remarkably, inflation in 1981 was 6%. And today, depending on how you measure it, it's about 6%. So you've got the same level of inflation, but you had 14% bond yields, whereas today they're interest rates, whereas today they're 1%. I mean, the difference is remarkable. You had much lower levels of debt. You had much higher levels of savings, which could come down, obviously, to augment consumption. You had much, much more attractive valuations. Sebastian showed you that Schiller Cape, that long-term PE. It was sub 8 times back in 1981. It's still about 28 times today. And finally, the baby boomers were 26. So they were just about to embark on buying houses, having children, basically consuming, which drove the economy. Today, the opposite is true. The average baby boomer is now retiring, which has implications for consumption and spending and so on. So it's just a very different world. And one in which we think you should be fairly cautious. And this is reflected in the bond market. So I'm saying here that interest rates are interesting. I know that everyone doesn't think that, but I certainly do. The 2-year note in the US, which is effectively the short-term interest rate, has gone from virtually nothing to over 3% in a matter of weeks. I mean, that is a truly remarkable event and ties in directly to what Sebastian was saying. The world has changed. The era of free money is over. And that has real implications for companies, for investors, for economies. It's just a real change in how we've been operating for so long. But what's interesting to me is whereas the short-term note's gone very quickly to 3%, the difference between the 10-year note, i.e. longer-term interest rates, and shorter-term interest rates has actually been falling. So whereas short-term interest rates have gone up very quickly, longer-term interest rates have gone up much less quickly. And that so-called inversion of the yield curve usually precedes a recession or a big slowdown. And it's one of the only really reliable, it's not always right, but it's a very reliable indicator within what is a very uncertain world. And lo and behold, we are now beginning to see a slowdown. So once again, it's a time for caution. So the question is, what do we do? Well, we do what Blake said, basically, but we do it on a global basis. So we try and invest in highly resilient, highly predictable, high-quality businesses. This is what Troy is known for. We try that and then use those to develop above-average returns with below-average volatility. Now, volatility matters, because if you're young, volatility is your friend. High volatility allows you to buy assets more cheaply, and you've got plenty of time for things to come right. With the greatest of respect, when you're not quite so young, volatility is your enemy, because you haven't got time to make up the losses if you suffer steep drawdowns over short periods of time. So we want to be producing decent returns, but with below-average volatility. And we want to grow the dividend backed by genuine cash flow, precisely what Blake was saying. The dividend on the trust today is about 3%. And I would say this, wouldn't I? I don't think you'll find a higher quality growing 3% yield anywhere. Finally, Troy being a competitive place, Sebastian put up a chart showing that the US market was pretty fully valued relative to history. So I've got 2 charts up showing that the US market is relatively fully valued relative to history. Schiller Cape on the right, and the US market cap, i.e. the overall valuation of the market relative to GDP. So market valuation relative to economic valuation, if you like. And it's above, should we say, it's pretty high. And Warren Buffett describes it as his favorite single indicator of the value in the market. And so it would suggest to us that it is a time for being a bit careful. So what do we own? Well, we own a selection of businesses that, again, very similar to what Blake would say. So we have a exposure to branded consumer goods. We find these businesses to be very resilient, very predictable. They've dealt with inflation in parts of the world like emerging markets for decades, and they just tend to be, we think, remain very attractive businesses. You might say, but aren't they suffering from rising input costs? The answer is yes, they have been, and they've suffered some margin squeeze as a result of that. But actually, first of all, the market's been remarkably efficient in rewarding businesses which have got pricing power, like Hershey is a chocolate business. You don't really think about the price of a bar of chocolate when you buy it, you just want it. Whereas others, such as Unilever, had a bit more difficult time, but there are a few other things going on there too, obviously. But my point is, I don't think input costs can keep going up at this rate. After all, if oil price continues to rise as quickly as it has been, we are going to have a crunching recession. But it also means that if the input costs are beginning to ameliorate, these companies have taken price. Today's margin squeeze is tomorrow's margin expansion. They may actually be very well positioned. We have exposure to platform businesses, Chicago Mercantile Exchange, hotel group that Blake mentioned, Nintendo. We love Nintendo. We think it's a really interesting global income idea. We have exposure to software, and we have a group of world-class businesses that we've grouped together as historically dependable income, which I'm sorry doesn't mean a lot, other than they are actually world-class businesses, and we're very happy to have them in the portfolio. We have a global portfolio. It's taken me years to realize it. One of the great arbitrages, in my view, that investors can avail themselves of is to live in the UK because it's fantastic and invest in the US because that's where they make all the money. And that's been true for a long time now, and I think that is an opportunity that you can take advantage of in this trust. So you can see half the portfolios in the US. That's going to be the case, I suspect, forever. We find it to be the best economy. We find them to be the best companies. We find the dynamism of that economy and the way in which they're respectful of shareholders' capital is just a fantastic place to invest. We do also have 25% in Asia and emerging markets. The ex-CEO of Unilever always used to say, you've got to invest in emerging markets because that's where all the people are. And it's true. And so we do have some exposure there. And our companies will be allocating more money to those countries over time because the margins are attractive, because of the growing middle classes and so on. Now, Troy is known for doing relatively well in more difficult times, and we are demonstrating this in our strategy as well. I've been saying until quite recently, until the recent drawdown, isn't it remarkable? There's only been 3 drawdowns of more than 10% since I launched the strategy at Troy in 2016. I think there's now a 4th, actually, so I have to update this chart. One of them is pretty short and sharp, I grant you, COVID. But in each of them, we've done rather better than the market, which is what one, I hope, would expect to see. So what are we left with? Well, I always think this is the most important chart in the book, in a sense. We are showing on the left-hand side valuation metrics, PE, free cash flow yield, what a company can pay out to its shareholders after funding the business, yield, and on the right-hand side, some metrics showing that we are compounding capital at a rate that is higher than the underlying market. So it's a high-quality portfolio. Point is, we think, because of the resiliency and predictability of the sorts of businesses in which we have, that 5% free cash flow yield should grow at around 5%. And if you think in terms of a forward expected return, 5% free cash flow yield growing at 5% should give you, not guaranteed, not every year, not in a straight line, about 9 to 11% per annum. So if we can deliver a 3% income yield for people to cover their day-to-day expenses and double their capital every 10 to 12 years via the rule of 72, well, that strikes me as a pretty sensible place to be allocating capital. I mean, I would say that, wouldn't I? And I would always think that's the case, but particularly today. And actually, my personal 16-year track record, that's pretty much what I've delivered over that time. So the chart, most of this chart has nothing to do with me, because obviously we were only appointed in November 2020. But the performance has been pretty respectable since that time. So I hope that's given you a clear idea of how we're investing in this trust, what we're trying to achieve. And to the risk of repeating myself, we wish to be seen as the quality, low volatility, global income trust in the sector.